Hello, I'm Matt, and welcome to ValiWorld. In today's episode, we quote Catherine Wood, which is, "Investors beware, stay on the right side of change." Catherine Wood, by the way, if you haven't heard of her, is the founder, CEO, and CIO of ARK Investment Management LLC, or ARK Investment in a short way, an investment management firm that managed the largest actively managed exchange-traded fund in 2020. She does not keep any secret regarding her researches on investments and finance. In fact, she has a complete section on her website dedicated to them. In one of the papers, she advised/warned investors to stay on the right side of change. What does that mean? Well, ARK's research suggests that the global economy has entered a period of convulsive changes, some exponentially good and others devastating, that will shape financial markets for years to come. Thanks to seeds planted during the tech and telecom bubble more than 20 years ago, record-breaking technological changes are creating not only exponential growth opportunities, but also black holes in global economies and financial markets. Staying on the right side of change will determine success and failure not only in investment portfolios, but also in careers, companies, and countries. Where are the black holes associated with technologically enabled innovation? From the ARK's point of view, any company not invested aggressively in one or more of 5 major innovation platforms and 14 technologies evolving today will lose its way. The 5 innovation platforms that ARK Invest believes will transform the global economy are DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. These platforms involve 14 technologies including gene therapies, 3D printing, cloud computing, big data analytics, and cryptocurrencies. Importantly, they cut across economic sectors, posing problems for research efforts that are short-term, siloed, and highly specialized. In the terms of ARK's experience, most research departments in the financial world are structured in that way and have created inefficiencies to exploit as convergences create the new world order. Among the siloed sectors at risk of disintermediation are energy, industrials, consumer discretionary, communication services, healthcare, and financial services. As autonomous transportation evolves, for example, autos, rails, and airlines are likely to capitulate to the convergence of robotics, energy storage, and artificial intelligence. Combined, they will collapse the cost structure of transportation. Traditional healthcare is likely to give way to the convergence of next-generation DNA sequencing, artificial intelligence, and gene therapies, the combination of which should boost returns on investment significantly, creating a golden age of healthcare likely to rival that of the 80s and 90s. Meanwhile, traditional financial services are likely to commoditize thanks to application programming interface or APIs, social platforms, and blockchain technology that will enable the convergence of business and consumer marketplaces, disintermediating the middlemen dominating today's financial ecosystem. The convergence between and among innovation platforms and technologies seems to be throwing economic and company forecasts for a loop, particularly in the developed world, which is saddled with mature infrastructures. Broadly defined, the sectors at risk of disintermediation account for more than half of the S&P 500 index. Though at small bases today, in ARK's point of view, most of the platforms aforementioned are entering exponential growth trajectories thanks to the failing cost and increasing productivity associated with technological-enabled innovation. For example, in response to the 28% cost decline in lithium-ion batteries for every cumulative doubling in units produced globally, electric prices will continue to fall, turbocharging electric vehicle sales. According to ARC's research, electric vehicle sales will scale 20-fold globally during the next 5 years, from an estimated of 2 million and around 2.5% of the market this year to 40 million and around 45% in 2025. If ARC is right, the good news is that electric vehicles will generate exponential growth in the auto market for the first time in 100 years. The bad news is that, just as rapidly, the more expensive gas-powered cars that dominate the market today will lose almost half of their sales base. Moreover, if transportation goes autonomous, as ARC believes it will be, the auto market will continue to shrink as the capacity utilization per car increases. In other words, as measured by statistics born in the industrial age when the sector was nascent, auto-related GDP will drop dramatically in the years ahead as unit sales and prices suffer, all to the benefit of consumers. Not for 4 to 5 years should the exponential growth of electric vehicle sales stabilize the industry, albeit with a new cast of characters. Meanwhile, consumers stand to benefit as the cost of transportation declines. Based on ARC's research, as autonomous vehicle networks scale during the next 5 years, transportation costs will drop more than 50% from 70 cents per mile to 25 cents. More broadly, if ARC's forecasts for the 5 innovation platforms are near the mark, nominal GDP growth in the US is likely to slow from 4.1% at an annual rate during the past 5 years to 2 to 3%, regaining momentum only after new technologies and solutions gain enough critical mass to move the economic needle. Both volume growth and inflation are likely to surprise on the low side of expectations as market share shifts to the mismeasured digital world and as the good deflation associated with technology takes hold. ARC believes the winners will win in a big way, but losers, particularly those that have levered balance sheets to satisfy certain stakeholders, will unwind. While risk-free interest rates are likely to remain low, credit spreads could respond dramatically as disruptive innovation causes significant dislocation. So investors beware. According to ARC's research, innovation is evolving at such a rapid pace that traditional equity and fixed income benchmarks are being populated increasingly by so-called value traps, stocks and bonds that are cheap for a reason. Critical to investment success will be moving to the right side of change, avoiding industries in the crosshairs of creative destruction and embracing those creating disruptive innovation. So after analyzing the whole article, we see ARC's point of view. Invest in disruptive innovation and you'll be covered. If you liked the video, please give it a thumbs up, share it on social media, and subscribe to ValiWorld. Comment below if you want to know more about finance, technology, innovation, and entrepreneurship. Have a good one and thanks for watching.